The Wolf of Wall Street may have set a Guinness World Record for the amount of swearing in a feature film, but it was also a great eye into market manipulation. Just like with the pump and dump scheme in The Wolf of Wall Street, today you see hedge funds engaging in massive shorting of stocks, which is manipulating the market. I'm Andrew Esquire, and this is The Legal Mindset. And we're gonna break down the situation with WallStreetBets, with the GameStop stock, with Robinhood, the SEC, and everything that has been going down in the stock market right now. So we're gonna get into that with a legal point of view, using the legal mindset to train you and give you an unfair advantage. First, we want to look at the facts and what actually happened with GameStop, Robinhood, and WallStreetBets. So first of all, what is WallStreetBets? WallStreetBets is a very popular page on Reddit. And Reddit, as you know, is a forum type community where you can gather, exchange information, and it's generally open to the public. Sometimes there's a membership requirement, but typically Reddit is open to the public, and anybody can post information on Reddit. Now, some of the posts would be about great stocks that had very favorable technical analysis and were good long-term bets, while others were more speculative options, as you might say, YOLO options, that were shooting for the moon, were shooting for a huge payoff. But one of the pieces of intelligence, the posts that was posted on WallStreetBets, was a technical analysis of GameStop. When you looked into the technical analysis of the GameStop stock, it became aware that Melvin Capital, a large hedge fund, was shorting a huge portion of the GameStop stock. In fact, they were shorting over 180% of it. Now, what is shorting? To put it very simply, shorting is essentially making a bet that a stock's price will go down. So you make money if the stock's price goes down, and you lose money if the stock's price goes up. It's a very risky bet. Most people aren't encouraged to short funds, but hedge funds, that is institutional investors and traders, often short stocks. In fact, it's a common practice to make lots and lots of money on the stock market is to short a stock in the near term or the midterm. Now, they had taken a huge position in GameStop, so we're betting huge that GameStop would go down. And that was keeping the price of GameStop very, very low at around $4 a share. So the folks on WallStreetBets said, hey, if we get together, we put money in this stock, we bring the price up, that will actually force them to get out of that position, to stop shorting the stock. It will also force other institutional investors to come in and invest in GameStop and bring that value up. So they went out and bought, and they didn't do anything illegal. It's very important to know that what they did was simply buying the stock at the rate at which was advertised on whatever platform they were buying it. Now, where are most retail investors, that is normal people, where are they buying their stock nowadays? They're buying it from Robinhood, from Webull, from TD Ameritrade, or any other of the many apps that are now offering zero fee, zero commission trading. So you can trade openly with zero fees. That is a thing that is completely new in the history of trading. Never before has it been so easy to trade stocks, and this has brought so many people into trading stocks. So we are still in the middle of a pandemic. We are still in an economic slowdown. And because of that, you have retail investors, that is people who are at home, normal people like you and like me, who are able to do the technical analysis, that are able to look at the facts, that are able to determine whether or not a stock is a good bet or a bad bet. And they were using platforms like Robinhood, Webull, TD Ameritrade, Charles Schwab to make those commission-free, those zero-fee trades. And they went in and they bought GameStop, and that swung the price huge, all the way up. It went from 4 to 400 within days. That's it. That's how quick a stock can move. And guys, some people did make a lot of money, but that wasn't the principle behind it, according to the folks on WallStreetBets. It was a David versus Goliath story in their mind. They were going up against one of these massive hedge funds. These hedge funds, which for a long time have shorted stocks and engaged in other practices to artificially deflate the price of a stock. Now, what happened? Well, needless to say, everybody freaked out. Not just Melvin Capital after they realized they lost most of their money. Politicians stepped up and said that they needed to regulate securities. They needed to regulate trades like this. And they didn't take the position of the retail trader. They didn't take the position of the ordinary man. Instead, media, politicians, and institutional investors all grouped up. They all ganged up to fight back against the retail investors. That's right. It didn't matter if you were on the right or on the left. This was truly the elites versus the people, the institution with the money versus the people. So, for example, regarding Melvin Capital, remember that group that shorted the GameStop stock? Well, a company came in, Citadel, and invested billions to save Melvin from going under. They also happen to be one of the biggest customers of Robinhood. They're one of the most massive users of Robinhood. So it might come as a coincidence that Robinhood all of a sudden prevented trading of GameStop stock. And they did it at just the time when GameStop was volatile. And stopping trading at these volatile times is losing investors millions in potential gains. In fact, the potential losses were so large that there was a class action suit filed in Massachusetts for Robinhood's shutdown of trading of the GameStop stock. And this spread outside of just Robinhood. TD Ameritrade also paused trading. In addition, the NASDAQ talked about regulating any trading that was based on social media. In fact, Discord, the exact same day, shut down the WallStreetBets Discord for alleged hate speech. Now, they eventually put it back up, but you can understand that disrupting this communication during this pivotal time all came together against the retail trader. Now, when we talk about market manipulation, what does the SEC define it as? The Securities and Exchange Commission, or SEC, has a very simple definition of market manipulation. Essentially, any action that artificially inflates or deflates a security. So any action that might artificially push up or push down a stock could be considered market manipulation. That's crazy broad, right? But we see that so often with government. If you want to see another great instance of that, check out my video on big tech taking over. We talk about how trust definitions are equally broad, and they do that to give themselves discretion as to when and when not to enforce. We saw this with Bernie Madoff, the Ponzi scheme guy. He got off relatively light in the light of the SEC. They really took it easy on Bernie because, let's face it, he was one of their guys. They knew Bernie. But here, the SEC is potentially going to take strong steps against retail investors. And even politicians like Elizabeth Warren have asked for protections to be put in place to shield the innocent retail trader. But what do we really see here? We've seen the government inflate securities as well by allowing hedge funds to take stimulus funding and inject it into the stock market. This has artificially inflated stock prices. It is a little bit unreasonable that the stock market during the height of the pandemic is higher than it was even before the pandemic. It is a clearly artificial price, but this is permitted. This is inside the ballpark. But for now, we have to wait and see what the changes will be regarding securities regulations. But rest assured, they will likely not be in favor of the retail investor. Until next episode, this episode is adjourned.